state of the mining business as it pertains to financing, and also get Eddie's story. He was instrumental in building Fortescue and raising $2.6 billion for that company. Eddie, thanks for doing this.
I'm filling in for the guest who isn't here, so you got no slides, guys, so it's just me. I'm going to talk for a little bit and then open it up better for a conversation with everybody here. But I was up on the panel yesterday. You guys would have heard that. If you look at what's going on out there at the moment, and coming back to Sean's wish that the industry resurrects itself and prices start moving, if you think about a business, we were talking about this earlier, you don't go into a business wishing that something's going to happen. You look at your business and can you make money doing what you're doing today? And the financing world looks at it from that perspective. If you're coming in to finance a copper project and copper's at 280 today, you're not running your models at 320, you're not running your models at 280, you're going to be running your models somewhere below that. The banks are going to finance you way below that. And you got to be able to show them that your project's going to be able to sustain that in whatever debt or that you want to put on the company to develop the project. And a lot of times I think that's where the equity markets get it wrong or have gotten it wrong, is the momentum that gets behind some of these companies. And so if you go through what went on a little while ago in the lithium space, all the lithium stocks ran, and now they've come back and people are like, well, how do I finance now? It's a case of, do I have a mine I can bring into production at a price that makes sense? And each project has to be looked at the same way in that regard. You know, we're talking about, okay. You know, we were talking about Arianne's market cap being 50 million and they need to raise 1.2 billion, okay? You look at that and go, never happen when you look at that situation. However, if they're able to get the offtakes they are doing now with long-term contracts with credible and credit-worthy counterparties, the banks will then come forward and tell them, okay, we will finance X amount at these rates, which then will allow the company to move forward and try to find an equity partner for the balance of what they're doing. So it's not 1.2 billion per se, because that debt and that company will be able to handle whatever that is if the numbers stack up. So I think it's also how you look at how you're going to approach that process, rather than think that you're going to go raise, or the market thinking that he's going to go raise $1.2 billion in the equity market and we're going to get diluted. And we did that with Fortescue. We're in the process of doing that with a company I mentioned yesterday called Sirius Metals out in the UK, similar type of asset. It's a potash asset in literally in the UK in Yorkshire. We raised $1.2 billion for the company 2 years ago. They're in the market right now for, I got to figure this out, but roughly around 4.2 billion. JP Morgan's underwriting 2.5 billion of revolver. They just raised 400 million of equity, 400 million of CVs last week, and they'll do a $750 million high yield piece. They've pre-sold 70% of their offtake. They'll be starting production in 2021, ramping up to 2024. But those numbers stack up, so you can do that. Market cap today of that company is about 1.2 billion. When we got involved with them, it was 50 million. And over the last 6-7 years as they developed this project, this is where it's been moving. So you can do it. I mean, when this is up and running, this thing will produce 1.2 billion of free cash flow at today's commodity prices a year for the next 100 years. So that's how the markets look at that, and you can get that money financed on these projects. It's not just for the big boys. Yes, if you're an independent and you've got a greenfield project like that, it's not easy compared to the other guys, BHP, Rio, and those guys are much easier, Mosaic, whoever, in terms of approving those things in their internal budgets. But the banks are looking at it no differently from them than they are from these guys. They're going to have similar collateral, they're going to have a similar type of offtake against those things so that they know that that product's going to go out the door. If you look at, and I think Paul, it was interesting that where Paul and how Paul's, when he was up here yesterday talking about some of his wins, that's the other thing that's interesting in this industry. Gold is the hardest one to predict, and I agree with Frank on that one, because it's not used. It's a proxy. So trying to predict where that's going to go in the future is much, much harder. The metals, including silver, that are used, much easier, because there's a production profile that's out there, and Frank was talking about zinc's in deficit. I think copper is going into deficit. If you look at, again, coming back to something like the lithium market, if you look at what they're predicting, if you add up all the car companies' electric vehicle production numbers for, I think it's 2025 or 2026, the lithium market has to double in production between now and then. If you talk to the majors who are in that space, Livent, Albemarle, SQM, they will tell you that's impossible to do. Even if you gave them $100 billion today, you couldn't get those mines up and running to double production. So what's going to happen? Car companies are not going to meet their numbers. There are going to be less EV cars obviously in the market, but the mining industry will catch up to that. So I think it's understanding what the cycles are and making sure that the project that you guys are all getting involved with and either building or investing in have the ability at today's prices to sustain themselves. And I made the comment yesterday, if you think there's a recession or a depression coming, you should not be in this room. Hard assets don't do well in that time frame. It's not something I believe in. I actually believe the other. I think we're going to have stronger GDP growth around the world than most people are predicting. But I'm an optimist. So that's basically where we come from. It's much harder, and we tap a lot of different capital sources. We're very deep into the U.S. financial markets, so hedge funds, mutual funds, private equity, the trading houses. We know a lot of the international mining funds that are around. We don't, no disrespect to the Canadians in the room, we don't do a lot up there because in the past a lot of those deals are bought deals, and this is my own business, so I don't want to put up that type of capital in that little club group. And I don't think it's the most efficient way to raise capital for companies, because I think the bankers are not aligned with the corporate. They're aligned with their institutional clients in terms of pricing that deal, rather than on best endeavors basis. So we work very closely with our clients in terms of that. I think it's getting harder and harder. I mean, again, you can look at whether it's Bitcoin, cannabis in Canada, or technology and biotech in Australia, but a lot of the investors that have been playing in the space are, especially on the junior side, are not there as actively as they were in the past. But there are still ways to finance companies, and I think that's just a matter of trying to be more creative over time. I think I'll stop there and just open it up to anybody's questions if they want. Yep. So the way we look at our business, we're agnostic, commodity agnostic to jurisdiction. The difference on that is, on the jurisdiction side, we know what can and can't be financed from the groups we talk to. So things, obviously, Venezuela is not something you're bringing to the United States for financing. DRC, you're not bringing to the United States for financing. Russia, you're not bringing to the U.S. There are different places that are much harder to get financed, so we know that. So we'll look at the probabilities, because again, I have 8 bankers who are working with me. There are other groups that we work with around the world, but so we don't take on projects. We don't believe we have a very high degree of probability of closing. So we'll look at the jurisdiction on one side. On the commodity side, more so it's the project. Yes, we'll look at the macro and say, I can see what's going to happen in something, and try to find investors that agree with that statement and see if they want us to help them find a project, and then we'll try to be more proactive. I think the better way to look at it is we've had a group family out of Australia that's been funding a very large greenfields iron ore project in Brazil for the last 5 years, and they've been coming to see us for the last 4 years. And we knew that there's no way we'd be able to do a greenfields project again where the iron ore market was, until a year ago they came to us and basically said that there were 2 steel mills as counterparties that were creditworthy that would take 20 to 30% of their offtake if they got it up and running, because they were worried about supply chain. Most of that for them was coming from their pellet feed iron ore, and for their furnaces, and that most of that feed was coming from Vale, and they're just worried about having that much exposure. That set off us talking to some of our clients to see if that was something that then would give them the ability to move forward on a project like this. It's a $3.2 billion project. And we're now getting to the point where we think we probably will have found capital for that project to move forward. So the answer is, I don't think, a business is a business. So we look at it where you are and what's going on. If we think that your project's coming into, if your project is too large in a very tight market and your production profile is going to disrupt things, that might stop us from doing it. Because, again, you have to, especially, I mean, talking about yours, phosphate or something like that, you're displacing somebody who's already in the market and embedded with whoever their customers are. So the likelihood of you being able to do that is harder if you're disrupting that market in terms of size. But that is also, no, I know you're not. I'm just saying that most of the commodities is rare that you're going to see that. And definitely not on an independent hand. I mean, a copper project that's going to disrupt the copper market, it would not probably be in the hands of any of us out here. But again, depends who it's a hard question to answer. The fees are much easier to, I mean, we know what the fees are out there, so it's scaled. I mean, again, depending on project and size. We're also not going to, I mean, if you look at Sirius, there's no way that we were going to go to $2.5 billion of bank debt. That truly is commercial bank financing that we won't normally bring to the table. We can introduce. We normally don't play around with fees on those things because they have a whole different fee structure that they play with. But on the bond market, equity market, CB market, you know, you're going to range from 6% on a smaller deal down to 1% on some of the debt deals. In terms of time frame, the way we structure that, we'll get a monthly retainer. And we'll work with the company in terms of what that timing looks like, but it depends on what they need to deliver, right? So if you need to deliver offtake agreements, I can't tell you I'm going to work for you for 6 months to get you the money if it's going to take you 18 months to get those offtake agreements. If it's going to take you time to get your BFS done or verify certain things. So just, I mean, we work with the companies in terms of what their business plans are and what they want to deliver, and we go forward from there. We also don't tie ourselves, I mean, one of the things I've learned, again, is being in the game long enough, a lot of the brokers around the world tie the companies up in terms of capital raise, so they'll basically tell you that any capital raise you do, you got to pay them. We don't do that. We believe that as your advisor, we're probably in the best position to raise you capital because we know the project best, but if UBS walks in and gives you $200 million, I'm not putting my hand up. Then I've done something wrong because they should never have gotten in the room. But that happens, and we've seen it happen. Where we see more of it is it's not so much the banks step in, but a strategic or somebody else steps in a joint venture. Now, we normally help them, advise them on that joint venture, but we will not take the normal fee for that capital coming in because we didn't originate it. I hope that answers your question. Okay. Any other question? Yep. Go ahead. Look, cycles change that. If you talk to fund managers that are generalists, not mining guys, so this is very important, right? Mining guys have to invest in mining stocks, so they're not the ones to talk to. If you talk to the generalist fund managers, large or small, they will tell you that they normally buy resource stocks when they can see GDP growth around the world consistently growing over the next few years, because they know that the wind behind the sails for everybody in the mining industry is there and prices should move up. You want to go sit down with a generalist and walk him through supply-demand issues around the world and tell him it's a supply side issue today because all the miners almost, I mean, if you go back, guys, 2012 to 2014, every single major mining company in the world almost went broke, right? They all were trying to sell assets. The problem was they were all almost going broke, so they couldn't sell the assets because they couldn't sell them to each other. And so very few assets ended up trading. They got lucky. Certain things happened, especially the guys who were in the coal business. China shut in a bunch of coal polluting mines in the coking coal, and coking coal within 6 weeks went from $100 to $330. They were printing money on that, and that got a lot of their balance sheets out of trouble. And you had a couple strikes on the copper side. Copper, I think, went from 240 to 280, 293 $3. Again, when you have assets that are, you got to remember they had the sunk capital, so it's just cash flow. When those things turn around, that generation is huge. So that, I mean, this comes back to cycles. You want to have assets and hold on to them because that's when it is. Fortescue is a great example. Andrew Force just paid out a special dividend last week where he pocketed $600 million himself from his shareholding. Why? Because of what's going on with Vale in Brazil has moved the iron. This goes back to supply, not demand, right? So nothing's changed on the demand side. You've just taken somewhere between 50 and 90 million tons of iron ore out of the market because there are dam breaks. That can't be replaced. There's no mining company that can turn around and say, okay, hold on, I'll just switch it on and another light goes on. It doesn't happen like that in the mining industry. So iron ore has gone from $60 to $100 on that back, and anybody in that industry right now just printing money, except for Vale. How does the equity change? I think it's hard. In this type of environment where it's just the GDP growth is growing slowly, it's very hard to change people's perception. And the last piece on this, which I think is extremely important from a U.S. perspective, but it's no different around the world, and I think Rob mentioned it yesterday about him trying to get into the S&P. Think about this for a second. The oil and gas industry, which we all know, there's Exxon, there's Chevron, makes up only 9% of the S&P. We are a fraction of that in the mining industry to the oil and gas industry. So when you think about that in terms of somebody, they don't have to invest in anything because it's not going to move their needle in the way they run their portfolios. So any of us trying to tell them a story has to be that exceptional that they're going to look at us versus something else. And the risk reward, right? So I mean, everybody jokes around about, what tech stocks have done, but if you go look at Apple in the last 20 years versus taking in a mining project to one of these guys for the same type of return, where would you go? And I mean, I'm not trying to be depressing here. I mean, it's just a reality of what it is. We got to get better at marketing. We got to get better at presenting. But the comment I'd make on my side, and that's why I've never switched to tech. I've never switched to biotech. This can still be done, and the returns are still there. I mean, you can find, whether it's Paul or Rob, Andrew Forrest, the Sirius project in the UK, they're constant programs that you can look at companies and see what they are and where they're going to go, and there's plenty of capital and plenty of money to be made and plenty of capital out there for the right projects. It's a matter of just thinking it through and thinking more like a business rather than a pet project. And I don't want to say this disrespectfully to the geos and the engineers in the room, but the mining industry has always had a problem that the geos love to drill and the engineers love to build. If you listen to Rob talk about the plant that he inherited, somebody let an engineer go crazy, right? They never needed to get down to that size particle on the gold in the way they were milling, and because of that, it was flying out the door because it was airborne, so to speak. Those are the things where a businessman has to sit in front, and you hope the geo or engineer is, but a lot of times they're not. That brings it together. I think it's more of a case of understanding that and trying to bring those projects. Robert Friedland's not a geo. Andrew Forrest is not a geo. Ike Batista definitely wasn't a geo. For those of you who don't know who he is, a Brazilian entrepreneur who built one of the largest mining enterprises in the shortest period of time, and then obviously watched it collapse because it had too much debt and no revenue. I think that's the biggest thing, is finding the right teams that you want to back, and I think the projects will come through. Again, I think too many people focus on the equity price. I get it. It's much easier if you were at a $200 million market cap than 50 to think about how you're going to finance that in dilution. I think if the projects are right, you still will be able to figure that out. And that's the comment I'd make. And you got to back the teams that are able to bring that project to fruition and to the end game. Give me the notice. Any more questions, or I'm around? Yep, go ahead, sorry. 80% of what we do is metals, mining, oil and gas, ag and infrastructure that goes around that. So we're building an LNG export terminal in Lake Charles, Louisiana. We brought a $1.5 billion equity check from a infrastructure PE fund out of New York for that project. The answer is most of the other stuff is industrial looking. It's not necessarily mining or oil and gas, but it's industrial looking. So, sorry, yeah.
On the equity question, how can you see the debt? You say you got to shore up the equity side to get the debt.
Sorry, what was that?
Shore up the equity side to close the debt.
Almost every, there's very rare that you're going to find that you're not shoring up equity. I mean, the debt, I've never seen a project where it's so robust that the banks or whoever's going to provide the debt is going to give you 100% of that. By the way, unless you've raised money and you have it in the bank, or you already have a project, you have revenue from somewhere else that you're using for this. But if you're a greenfields project and you prospector and whatever, it's very rare. But again, on the equity side, there are different ways to play with the equity, right? So I'm going to use, unfortunately, I'm going to use Arianne as the example here. But if tomorrow morning we wake up, sorry? If we wake up tomorrow morning and he's got $900 million of his $1.2 billion with a commercial bank saying, okay, he needs to raise $300 million of equity, one, his share price should take off because you've basically taken care of most of the problem. And two, there's strategics out there or others that will understand that will then joint venture with him on the asset at the asset level, not necessarily. So the $1.5 billion that we're bringing in for the LNG terminal, the company's market cap's $400 million. That 1.5 is going into the asset with a prescribed return for the PE fund. So there are different ways to do that. That again, it's diluted, but not as diluted as everybody thinks because of where they are. There are other guys out there that will. I mean, we were doing this for a large company that was selling down part of their. It was Anglo was looking to sell down part of their mine in Peru. They ended up selling it to Mitsubishi, but we had a financial institution that was willing to finance them for 12 years, and they could buy it back after 12 years. Same amount of money. I mean, the terms were obviously different, but they were able to get their asset back. It's a development project, so the board doesn't want to take that risk. So once they're in production, which they would have been over that period of time, a long-term asset. So there are different ways to look at this, and there are different pools of capital. I think the problem is a lot of the junior space is covered by guys who only understand equity. And so when you're looking at their, the way they pitch the stock to you as a broker, they're pitching equity because they don't know the debt markets. And so we look at this and say there's a lot more ways to play. And then strategics are, I mean, you know, we're in the process of setting up, and this is not a commercial, but Colin mentioned it, we're setting up a VC fund for the materials going into the batteries. We're not talking to any investors. We're talking to 22 strategics. We're talking to all the battery companies. We're talking to all the automotive companies, and they're all in the room. Why? They've never had a problem in the past sourcing. Now they know they got a problem. And they're not looking to us as a solution. They're saying this is innovative as a part solution to what they need to do to get more capital to flow towards that so they can produce what they need to produce from a battery point of view or from a car point of view or bus or whatever it might be. So there are different ways to look at each commodities and who could be a partner to get a project up. Gold is the hardest because there's, again, can't figure out who the strategic is, but in anywhere else there are plenty. And I'm out of here. Hopefully that was good.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?